For federal tax purposes, entity classification starts with a simple question: how many owners are there? One owner usually means sole proprietorship. Two or more owners usually means partnership, if they're carrying on a business and sharing profits. On the EA exam, they'll hide this inside a fact pattern. Your job is to spot whether the activity is a business together or just shared ownership. A sole proprietorship is not a separate legal entity. It's just you doing business. You can have employees, contractors, and a business name, but there's still only one owner taking the risk. Tax reporting is straightforward. Business income and expenses generally go on Schedule C. If you sell the business, the buyer doesn't take over your sole prop. They're buying assets and then operating their own new entity. With two or more owners, the default federal classification is partnership if they carry on a business and divide profits. The partnership itself generally doesn't pay income tax. Instead, it files an information return and pushes the results out to the partners. On the exam, the big tells are Form 1065 and Schedule K-1. Partners report their share on their own returns. A partnership must have at least one general partner. That person can legally bind the business and is on the hook for partnership debts. Partners also aren't employees of the partnership, so you don't issue them a W-2 for their partner share. That's a classic EA exam trap. If the person is truly a partner, think K-1, not payroll wages. Now, the weird but testable part. Co-owners aren't automatically a partnership. Co-ownership of rental property is often just a joint undertaking to share income and expenses. The key is whether they're providing substantial services to tenants. Substantial services means services mainly for the tenant's convenience. Think regular cleaning, linen changes, or maid service. That starts looking like a hotel business, not passive rent. Here's how reporting changes. If it's a basic rental with no substantial services, each co-owner typically reports their share on Schedule E, but if they're running it like a bed and breakfast with maid service and daily breakfast, it's no longer passive rental. That activity belongs on Schedule C, and if there are multiple owners operating it together, you're likely looking at a partnership filing Form 1065. Use the fact pattern to decide. If Cornell repairs things and Dolan collects rent and that's it, they're just co-owners splitting rental income and expenses. Schedule E each. But if Orlando and Suzanne remodel into 4 units and offer maid service and breakfast, that's a service business. The IRS treats it like a hotel. 2 owners plus an active business usually equals partnership reporting. Which form is used for a sole proprietor to make quarterly payments of self-employment tax? The choices include the estimated tax form for individuals, an information return like a 1099, the schedule that calculates self-employment tax, and a payroll tax return. Think about which one is actually used to send quarterly payments in. The answer is Form 1040 ES. That's the voucher system for quarterly estimated tax payments, and those payments generally cover both income tax and self-employment tax for a sole proprietor. Schedule SE is tempting because it calculates self-employment tax, but it's filed with the annual return. It's not how you make quarterly payments. Marcus is a sole proprietor reporting on Schedule C and wants to expand. In which scenario would he not be required to obtain a new EIN? Options include changing the business legal name and adding a second location, taking in partners and operating as a partnership, incorporating, or saying none of the scenarios avoid a new EIN. Think about what actually changes the entity. The answer is changing the legal name and adding a second location. That doesn't change the underlying entity, it's still the same sole proprietorship. Taking in partners changes the entity to a partnership, and incorporating creates a new entity type, both of which generally trigger a new EIN. The exam loves this. New EIN is about entity change, not growth.